Hey guys, my name is Kenny. I'm one of the analysts here at Trade Tips. Today we're going to be talking about moving averages and how we can use them to make trading decisions based off of them. Right here we're going to start by looking at the S&P 500 using the ticker symbol SPY or SPY. And in order to set up the moving averages, we're going to have to come up here on the top left section where it looks like FX and it says indicators and strategies. Now, there are different types of moving averages. Let's just start off with the basic one, which is just going to be this moving average right here. Go ahead and click it once, and you should see that it pulls up now a straight a line that has all of these things connected. Well, what it is that the moving average is built through an average. And right now it says we have an average of 9. So what the average of 9 means is it grabs the closing price of this bar, this bar, this bar up to the last 9. And when you have when you take the average of the last 9 bars, it goes ahead and plots it on the chart. Now with just one moving average alone, it doesn't help us much, and we want to do one little change as well. So if you go on the top left here and go and click on settings for moving average, you can go ahead and change the length of it. In my opinion, 9 hugs the price a little too much to the point where it doesn't give you any valuable information. So we want to go ahead and switch this to 20. And 20 gives us a little bit of a better idea of what's going on. You can see that the 20 moving average actually kind of gives us kind of a line of where maybe it possibly could bounce from. But even then, so sometimes this might not be enough information. So let's go ahead and add just a couple more. So if you type in moving average, click, that gives us 2 more. So let's go ahead and change this one to 50. And then for the next one, we're going to go in the settings on this one as well, and we're going to change that to 200. Now, from here, then okay, great. So look, just the 20 by itself gave us this line where it could possibly bounce from. But when this line wasn't defended, there was another line that gave us a little bit of help as well. So the 50 moving average in this case helped us find possibly a bounce zone for the SPY over here. Now, as you can see, these moving averages are not all perfect. Of course, it doesn't capture these bottom wicks at all. And sometimes these can cause a little bit of scares, and that's why moving averages are not the end all be all. Like this is the thing that will give you guys all of the money in the world. But they do provide us some valuable information. And so you can even see here where because we're trending up so much that we're not even getting close to the 200 moving day average. When we like to define these averages, it's easier to just sometimes justify them as the fast moving average. In this case, it's going to be the 20. The medium moving average is going to be the 50. And then the slow moving average is the 200. And why do we call it so? Because as price moves up, you can see that the 20 moving average is kind of the fast moving average because it kind of hugs the price a lot better. The 50 a little bit lags more, and so this one actually captures this bottom wicks over here when it comes down. And then the 200 is the slowest moving average where it doesn't move too much, even though the price is going up and up and up, the moving average is still kind of slow to react. And so when looking at these combined, we're able to make better decisions for ourselves. Now, we actually here at Trade Tips don't like to use the regular moving averages. We find that they lag a little too much. And just as an FYI, these moving averages are called lagging indicators for a reason, because they lag in price. So you can see that, the price moved up to 395, but for example, the 50 moving average is still at the 386 mark. And so we call these lagging moving averages, and lagging moving average can be a little bit laggy. So if you're trying to define a trend change that's happening pretty quickly, these can only really act best as supports and resistance zones, and not as not a definitive, they're not good indicators to indicate a trend change. So those are some examples for that. So I do actually want to make a quick adjustment. What we're going to do is, instead of using the regular moving averages, we're going to move towards the exponentials. So I'm in the process right now of removing all of those. I'm going to leave the volume on for now. We're going to go back to the top left, find indicators and strategies, and you're going to type in the word exponential. Now when you do that, we could just get 3 or 4 of these, but what I like to find is that there are a public library of people who are trying to save up space and try to use just one indicator that has all 4 of them. So let's go ahead and try this one. It has 4 exponential moving averages all in one, and it's already pre-built for us. So it has the 20, the 50, 100, and the 200. These are the most common moving averages that you will find. And these ones, instead of SMA with the simple moving averages is what we were looking at earlier, we actually now have EMAs, the exponential moving averages. What the exponential moving average does is that, for example, on the last 20 or so closing prices, it's going to weigh the latest bars more heavily in the average. So you'll find that they're going to be a little bit more accurate, in my opinion, as far as holding on to price a little bit longer. As we said, these are lagging moving averages. So if you do simple moving averages, the last 20 bars are equally weighted, whereas an exponential moving average, we're giving more kind of more priority over the last few bars, as opposed to, you know, giving an equal weight to all 20 bars. So we like to use the 20 EMAs, and in my opinion, this chart could use a little bit more of a cleanup. I find that these 2 colors are a little bit too alike, and so we can actually change those by going to settings again. 20, 50, 100, and 200 should be fine for what we're doing today. And let's go ahead and change these. So go ahead and click that button for the color. We can change this to blue. And I like to make them a little bit more thick so you can actually see them a lot better. So when we go over to the fast one, let's go ahead and do that. So this is the, just to kind of make the names clear. So this is 20, 50, 100, 200. So this is going to be the 20, 50, 100, 200 on here. So let's go ahead and change the 100 now to a little bit more of a thicker band, and then the slow one, I like to make this a little bit purple, and there we go. Then with all of these combined, we can actually use these to help to find a trend. So if, for example, if you were to just look at this SPY chart just by itself, you would just be like, okay, yeah, it's in an uptrend, but how can we definitively define that it's in an uptrend? We can use the moving average and see that these lines create a band, where these bands are separated, where the 20 is above, the 50 is below, the 100 and 200 are as such. So as long as these bands are all parallel and so they're not touching, that then you can that's how you can definitively define that a trend is still bullish in this case. Now, if you look over here, when we had a little bit more volatility in September, we found that the price went below the 20, and you can see here that the 20 bounced off of, or actually it bounced off the 50 moving average, and the 20 acted as resistance, where it kind of blocked it and came down to the 100. You can see that what ends up happening in times like this is that it gets a little choppy, and when you have a faster moving average crossing below the 50 moving average, that's usually a bearish signal. And when that happens too, we actually have a definition for that. It's called a death cross, is when you have a faster going below a slower moving average. But as you can see, we still had the 50 or the 100 and the 200 moving day average helping us as a level of support. But that's how, but especially when you lose this 20, that's when things get a little bit more choppy, especially in bullish markets. And so we found that especially when it came through here and here, it kind of just chopped a little bit sideways and was a little harder to predict. But what you can do is just wait for another opportunity where we can hit maybe like one of the 100 moving averages and see if it continues up for us. And if you just bought on the 100, you can see that you were super well off in that kind of a trade. Okay, so with that being said, this is a little bit this is a very clean chart. Not all charts are this clean. So if you want to look at a little bit more of a choppy chart like Netflix, you can see that things that are chopping around like this. So let's go and turn it off, where you can't clearly find where there is a trend in here, because there isn't any. If you ask the moving averages, what is the trend in Netflix, you would probably just say it's going sideways. And so, you couldn't, and when you go into sideways markets, moving averages will not help you, because what they end up doing is just creating a whole bunch of false signals where you have like the 20 crossing below the 50, and that's a bearish signal, a death cross. And then now both of them crossing below and causing another death cross on a higher time frame on the 100. And then when you cross above, it's called a golden cross, and then you would have got another signal to go bullish. And in general, moving averages should not be used in sideways markets because of all of the false signals that you gave. In another video, we'll talk about supports and resistances, and those are going to be better used for sideways markets. Let's go ahead and look at another easy one, BIDU. It's a Chinese stock. So BIDU on Friday of March 26 ended up dropping all the way down, losing a good chunk of their gains, of course. Let me see if I can find how far that went down for us. And from the beginning of the day to the low of the day, it looked like it dropped 16% on the day. And look where it ended up bouncing. So if you ended up saying, hey, I want to buy it on the 200 moving day average, boom, you would have bought it around the $175 mark and up to 208. Dang, that's from there to there, that would have been almost an 18% move for you, especially with options. You can really capitalize on those opportunities. You can see that we had the clear band separation, unlike in Netflix in here, where we had the clear uptrend. And as soon as we lose 20, we start to get a little bit more volatile. And when you get to here, sometimes it's a little hard to see, but sometimes what it can do is it gives us a little bit of an entry. So if you said, hey, you know what, this is a little choppy, you want to buy it on the 100, you want to go see what happens on the day that it hits 100. Over here, it was still a little choppy again, breaks down. In this case, if it's super far overextended and you see that it's going to hit a longer term moving average, then that could have been a buy opportunity for you. And in general, what we find is that the slower moving averages and in the higher time frames, they have a lot of power. So we would say that the 200 moving average, because it's the slowest one, it has the most power. And this one would have a medium amount of power, and this one would be like a very these are like low. These have low power. What I mean by power is by like the power to bounce or the power to like reject. So for example here, you can see that as soon as we hit the 200 moving day average, we saw a bounce that was almost an 18% bounce just from the lows, and we can see how powerful that is to buy off of 200-day moving averages, for example. For the last example I have for you guys, we're going to be looking at Tesla, where in Tesla, as soon as we lost the 20-day moving average again, we can see that it starts to get a little bit more choppy, a little bit more volatile in here. Some person could have decided to want to buy on the 50 bounce, but when you saw that it doesn't actually come up in price again above the 20, that could be a little bit of an issue. You can see that after that minor bounce, nothing really happened. So then the market got scared again, lost the 50, and look. So because the 100 moving day average is a little bit slower than these, it has a little bit more power. So it has a bit more power to bounce. And even if you just capitalize on the bounce off of the 100, it would have made $120 per share gain, or a 20% move in just 2 days, which is extremely powerful. And when you get towards here, when you lose this 100, then you can see that things get a little choppy again. In this case, you want to just try to make sure make sure you find anything that's a little bit more definitive. Like here, we do get a little bit more chop, and that's usually because we have a lot of moving averages converging into one, and so it's hard to say what's going to happen here. We could reclaim this, or we can go back down and touch the 200, but in this case we call this a no man's zone. It's kind of hard to definitively give yourself an edge as to where you would want to buy this. But for example, if you looked in the chart here, like what we look for in trading opportunities is trying to see is like, okay, do we have an overextended move to the downside? And oh, hey, look, we're at the 100 moving average. Maybe that could be a buying potential opportunity for you guys. And that's why, that's how we can able to find some of our signals for you guys. Because it's not going to happen every day. So for example, if you wanted to trade Tesla every day, you would just have like a day of sideways, a day of sideways, a day of sideways. And that's why we look to multiple different stocks, because different stocks can be in different areas depending on where you are at the chart. And so, with that being said, you can use these also on the lower time frames as well. But what you'll find is that they're going to be a little bit more choppy, and this is why we don't really use these too much. So this is the 1 hour chart, by the way. And so in these type of scenarios, I like to just get rid of the 100 and the 200 to give us a little bit of a better picture as far as trading it intraday. If you just even looked at Tesla here, although it gets a little choppy here, wait for it to do a little bit of a separation. And when you do that, you can see that the 20 and the 50 could have acted as short opportunities for us to make money on the way down. You could define a strategy as, hey, as soon as we break above the 50-day moving averages, I'm gonna quit my shorts and go long. And if you just held on to, for example, if you just bought the break below, and you just held on and held on and held on until the 20 moved, until the price moved above the 50, you could have realized a move that took us down from all the way from the 840 area all the way up to even the 650s, which would have been a $200 gain. So have fun with these. They are not the end all be all of indicators, but they are extremely helpful when it comes to looking at the market as far as looking at averages. Like without the charts, without the indicator itself, you could be a little lost in these charts sometimes. So these indicators can help us kind of define trend change and also give us entry zones and for us to enter into trades, as we saw with BIDU in on our 200-day moving average, as well as other names like Tesla, where we saw like a bounce on the 100-day moving average. So with that being said, we hope you guys are being a little bit careful as far as the markets are going, because we are seeing a lot of very volatile movements with a lot of trend changes happening even intraday, and it's hard to kind of find good entries for you guys when the markets are super choppy like this. As we can see with like the Tesla chart, or with the Netflix chart, we see a lot of sideways movements even in this lower intraday time frames. So we want to be careful and not expose ourselves too much, or buy us some time when we get into these trades. With that being said, if you guys have any other questions, let us know, and we'll be looking forward to the next video with you guys soon. Take care. Bye-bye.